In the wake of the global economic crisis, it is only natural to expect that the banking industry would form its own responses, especially on the risk management front, as to how things should look like going forward. One of the organizations that is leading the discussions globally is the IIF, or the International Institute of Finance. My guest today is Mark Lawrence, who's had a long and distinguished career in risk management. He spends a lot of his time in the various committees and subcommittees at the IIF. Mark, if I were to ask you what you think would be the focus of the single most important initiative of any banking discussion on what risk management should look like, what would you put your finger on?
Thank you, Emmanuel. Good question. Let's be clear that the financial crisis really was, among other things, a catastrophic failure of risk management in some of the largest banking organizations in the world. So as we seek to restore confidence in the global financial system and the banking system in particular, it's essential that we understand what went wrong in risk management and what do we have to do differently. So what's true is that the biggest banks didn't properly understand the risks they were taking or manage them properly. And these are banks, after all, that had spent many tens of millions of dollars on risk management, but it didn't work. So the first thing we need to do is understand what went wrong and what do we need to do differently. More of the same is not an option following this crisis.
You serve in a number of different committees, and you had the working committee or working group on risk management that feeds into the IIF steering committee on implementation. What would you say is the focus of the subcommittee and the main committee that you work with?
Okay, putting the current IIF work in context, when this crisis really hit in sort of the second half of 2007 and firms started to announce big losses and some CEOs departed very visibly, the IIF, the main global industry body in the banking industry, formed a big committee with representatives from many of those most affected banks to try to analyze what went wrong and learn some key lessons. That committee, called the Committee on Market Best Practices, actually published a report with some recommended principles of conduct and more than 150 specific best practice recommendations in July of last year, July 2008. Subsequently, the industry and the global regulators want to understand how is the industry going in implementing these best practice recommendations. This is the first time, by the way, that the industry globally has attempted to write down in one place best practices, specific recommendations around things like risk management. So the question is it just a document? Is it being implemented? And as we sit here in the middle of 2009, having learned a lot more in the last year, do any of those recommendations need updating or further expansion and amplification? And that's what that risk management working group that I co-chair at the IIF is doing right now.
If we were to look at how risk management has evolved in the banking industry, and if we took Basel II as the starting point of what we have to deal with today, what would you say were the inherent weaknesses in Basel II that may or may not have caused banks to respond wrongly or inadequately to the crisis, and what do you think needs to be corrected?
Very important question for folks to understand. Everybody should understand that even today, as we have this conversation in May 2009, Basel II is not yet implemented in the United States. So Basel II did not cause this crisis. In fact, the distortions and incentives contained in Basel I had a big role to play. You could argue that if Basel II had been implemented a few years earlier, the crisis wouldn't be as bad as it is. Now, having said that, the crisis has revealed many weaknesses in industry practices and also revealed some weaknesses or gaps, really, in Basel II. So Basel II itself is a significant strengthening or improvement over Basel I, which had many weaknesses. Basel II itself is now being improved, all of which creates quite a big burden for banks, and some of the key elements of those changes are probably worth understanding well.
If you put Basel II in context in that manner, there were a number of different initiatives, all of which I would say contributed to exasperating the wave, the pro-cyclicality
Yes,
of
yes.
the
Yes.
crisis. In that way, you had mark-to-market, you had the governance regulations, you would even throw in the Sarbanes-Oxley in there.
Sure.
Banks were expected to put more capital just when they needed to release capital to respond to market sentiments and so on.
Yeah.
What would you say are some of the initiatives underway right now to sort of soften the way in which we respond to crises, and what do you think needs to be done?
Yeah, there are really two probably major initiatives, fixes or changes that everybody's working on right now, the industry and the regulators. The issue you're referring to is one of them, and it's the issue of pro-cyclicality. So in other words, capital in concept should become like a shock absorber. Build it up in the good times and then eat into it in the bad times. And that would then dampen or at least mitigate that pro-cyclical effect which amplifies the impact on the economy. That's the idea. Question is, how do you actually do it in practice?
Right.
Without creating other unintended consequences.
And in that scenario that you've just created, where do you factor in what is being called the black swan?
Right. I think you're now asking about the core of risk management, right? The way banks work is that business people build business plans based on what they expect to happen. They work out expected volumes, expected GDP growth, expected market share, margins, and pricing, and so on, right? We want to make sure 99% of the time we're going to be fine. We want to make sure the other 1% of the time that we're in good enough shape to be able to still survive and still be robust and carry through that difficult time. That's what risk management is all about. Planning for the unexpected. Now, in practice, you never know exactly which unexpected scenario is going to materialize. So what you need to do is become quite good at two things. Number one, understanding how the environment is changing so that you can quickly detect when something unexpected or dramatically different is beginning to happen. And number two, being well prepared in advance with a variety of potential response options. So being nimble, if you will, to be able to recognize quickly the new unexpected black swan that's happening and then being able to respond in a very nimble fashion. The end-to-end ability to do that is really the ultimate test of a bank's risk management understanding and capability.